Welcome back to the deep dive. If you've been tracking the biggest structural shift in finance right now, the integration of the digital world with physical value, then, we're talking about tokenization.
Specifically, bringing real-world assets, or RWAs, on-chain.
Exactly. And we've talked before about the what. What assets are we talking about? Real estate, corporate debt, even fine art.
That's absolutely right. But understanding the what is really just the introduction, isn't it? Today, we're trying to move from that vision of tokenization to the essential engineering behind it.
Yes. This is for the listener who has followed the buzz but now wants the blueprint. They want to know not just that this is happening, but how. How does the tech, the law, the market, how does it all actually work together?
This is the deep dive into the engine room.
It is.
And, that's where the real value is. To really get your head around the potential of RWAs and why these big institutions are pouring billions into the space, you have to grasp the components that power it.
And they're all interlinked.
Completely. If you miss one piece of this mechanical triangle, the whole vision just kind of falls apart.
Okay, so let's unpack that. We're focusing on 3 pillars that have to work together perfectly for this to function. First, we've got smart contracts.
The automated rules.
The automated rules. Second, fractional ownership, which is the whole economic concept that breaks down those old investment barriers.
Right.
And third, the blockchain infrastructure, the rails that everything runs on.
And if you can master how those 3 things interact, you understand why tokenization isn't just, another crypto trend. It's poised to be the biggest driver of blockchain adoption for the next decade.
It really feels like it's rewriting the rules of ownership.
It is, fundamentally.
And that transformation, that's the end goal, isn't it? The whole point of this tech shift is to leverage code to solve what centuries of traditional finance couldn't quite fix.
Making these high-value, illiquid assets more accessible, more transparent, and, instantly tradable globally.
Think about the friction in the old system.
Oh, it's immense. If you wanted to sell a piece of commercial property or even a small stake in it, you were looking at months of work.
Lawyers, banks, intermediaries.
Mountains of paper, legal costs that just killed smaller deals before they even started. Tokenization promises to shrink all that down to, milliseconds and pennies.
That sets the stage perfectly. Let's dive right into that first pillar, the automation layer, the engine of the whole operation. Smart contracts.
Okay, so at their most basic level, smart contracts they're just lines of code that's stored on the blockchain.
But calling it a standard software program doesn't really capture it, does it?
Not at all. The key difference is that they are deterministic and self-enforcing.
What's so fascinating to me is how different that is from a normal contract. A paper contract needs people to enforce it.
Right, you need courts, lawyers, banks, an entire system.
But a smart contract is the enforcer.
Exactly. It doesn't need any human intervention once it's deployed. It just runs. It automatically executes the agreement when its predefined conditions are met.
And that gets rid of the need to trust a middleman.
Precisely. The trust isn't in a person or an institution anymore. It's baked into the code, which is publicly auditable and mathematically verifiable. The moment the condition is met, the outcome is just guaranteed.
Okay, let's use the analogy from the source material to make this concrete, because I think it's a great one. Renting an apartment.
A perfect example of where friction lives in the real world.
So the normal process, you negotiate, you sign a lease, probably a bunch of PDFs, you wire the money or get a certified check.
And you get the keys. And the whole time, both the tenant and the landlord are just sort of hoping.
The landlord hopes the check clears.
The tenant hopes the keys work.
And the money and the access are in limbo, maybe sitting with some escrow service that's taking a fee and adding a delay.
A smart contract just cuts through all of that.
Yeah.
If we tokenize that rental agreement, the security deposit and the rent wouldn't be in bank account. It would be locked inside the contract's code.
Inaccessible to either person until the deal is done.
Right, until the conditions are met.
So what are those conditions? They have to be things the contract can see digitally.
Exactly. So condition A could be the landlord registers a cryptographic hash of the lease agreement on the blockchain. That confirms the term.
And the condition B?
Condition B could be the landlord provides digital proof of access. Maybe a unique time-stamped access code or a tokenized key that gets transferred to the tenant's digital wallet.
So once the contract sees both A and B are met and recorded on chain.
It executes instantly and automatically. It releases the funds to the landlord's wallet, and it finalizes the rental data in the tenant's wallet, all at the same time.
No manual bank transfer, no waiting for business hours, no chance for the landlord to run off with the money.
Or for the tenant to back out after getting the keys. The code forces the agreement to be honored.
And that deterministic execution, that is absolutely foundational for tokenizing real-world assets. When you're dealing with millions or billions of dollars, that certainty is just. It's incredibly valuable.
But here's a really important point of complexity we have to address. When we apply this to something like a building, the smart contract doesn't physically own the asset.
Right.
This is where the idea of the legal wrapper comes in.
That's a critical distinction. The Kund on the blockchain can't hold a physical deed that's registered down at the county courthouse. So how does the engine actually connect to the asset?
Well, the contract handles the digital representation and the ownership rules. But it needs a legal structure in the real world to tie it all back to that physical deed.
So you create a company?
Typically, yes. The asset, say, that skyscraper in Manhattan, is owned by what's called a special purpose vehicle, an SPV, or maybe a trust.
So the SPV is the legal bridge between the digital token and the physical asset.
Exactly. The SPV owns the building, and the smart contract dictates who owns the shares of the SPV.
I see. So the contract's logic would say something like, this specific token owned by Wallet X represents a 0.1% share in the SPV, which in turn owns building Y.
You've got it. The smart contract is the technical enforcement for the economic rights that are conveyed by that SPV share.
Which means the contract also needs to contain the specific ownership rules. And this is why we hear about different token standards, right? We're not just using simple ERC-20s for everything.
You've hit on a vital technical detail. Yeah, an ERC-20 is great for a simple currency or utility token. But for RWAs, you need tokens with extra functionality to enforce all the regulatory rules.
And that's where something like ERC-1400 comes in.
Exactly. A standard like ERC-1400 allows for things like transfer restrictions.
So you can enforce KYC and AML checks.
Precisely. The contract can be programmed to only allow transfers between whitelisted wallets. If a wallet isn't approved by the asset manager, the smart contract will just automatically reject the transaction. It prevents the token from going to an unauthorized party.
And that solves a massive compliance headache for institutions. The compliance is literally coded into the asset.
It's enforced deterministically. And because this whole system, the SPV, the token standard, the transfer rules, is all on the blockchain, you automatically get two huge benefits.
Transparency and tamper-proofing.
That's it.
Let's talk about transparency for a second. What does that really mean here, beyond just being able to see transactions?
Well, it means the rules of the road are visible to everyone. The formula for dividend distributions, the total supply of tokens, how cash flows are calculated, it's all encoded in the public ledger.
Which is a massive departure from, say, a private equity fund, where all of that is buried in an opaque partnership agreement.
Right, where only a few lawyers or auditors ever see the full mechanics. This reduction in opacity doesn't just build investor confidence, it dramatically cuts down the time and cost of due diligence.
A potential buyer can instantly verify the rules of the asset before they even think about buying.
And that leads right into the tamper-proof nature of it all. Immutability. Once those terms are deployed in the smart contract, they can't be changed by one person.
And it's not magic. Let's just quickly explain how the blockchain achieves that.
It's really just down to cryptography. Every new block of transactions is cryptographically linked to the one before it, using a hash. If you tried to go back and alter an old block to change who owns what, the hash for that block would change.
Which would invalidate the hash of the next block and the next, all the way down the chain.
Exactly. And to recalculate all of those hashes across the entire decentralized network at once is, for all practical purposes, computationally impossible.
So the cost to maliciously rewrite history is just astronomically high.
And that reliability, that efficiency, that's why the smart contract is the engine. It ensures the digital representation of the asset is completely trustworthy.
And that trust is what enables the next pillar, the one that really promises to change the investment landscape itself. Fractional ownership. The whole system only works if I'm certain my 1,000th of a share is secure.
The smart contract is that guarantee. And that guarantee is what allows the market to shatter those old investment barriers.
Okay, so we have the rules engine. Now let's move to the mechanism that delivers the big economic shift, fractional ownership. The power here is how it just completely dismantles traditional capital barriers.
And we have to start by acknowledging what that traditional obstacle was. Historically, if you wanted high yield returns, you needed access to elite assets.
Like grade A commercial real estate or blue chip fine art.
Exactly. And those assets were gated. You needed huge amounts of capital or, deep connections just to get in the door.
A structure that locked out most retail investors and even a lot of smaller institutions.
It created huge economic inequality by limiting access to the best performing, most stable assets. Tokenization is the sledgehammer that just knocks that wall down.
By using that smart contract engine we just discussed?
Right. It takes these large, high-value, physically indivisible assets and meticulously breaks them down into thousands or even millions of smaller, easily tradable units. Tokens.
And that is the core idea of democratizing access. So instead of needing, say, $5 million to get into a commercial building deal,
you could participate with $500, maybe even $50, just by buying a fraction of a token.
And the economic impact of that goes way beyond just letting more people in. It completely changes the liquidity of the asset itself.
Of course, when you suddenly open the door to a massive global pool of capital, you naturally increase the depth and the buyer base for that asset.
I really like the slicing a pie metaphor. It just clicks. You have this whole incredibly valuable asset, let's say it's a portfolio of government bonds, and tokenization just slices it up.
Exactly. Each token is a slice of that bond's future cash flow. And the critical part, which is enforced by the smart contract, is that the sum of all the slices always has to equal the whole pie.
Right, a one-to-one correlation with the value of the underlying asset.
Always.
Now, this idea isn't totally new. We've had things like REITs, real estate investment trusts, and mutual funds that offer fractional exposure. What makes this so much more disruptive?
It really comes down to the speed and cost of settlement. A REIT still trades on traditional stock markets.
So it's subject to market hours, T+2 settlement?
Exactly. It can take days for the trade to finalize. Tokenized fractions running on these blockchain rails are aiming for near instantaneous T+0 settlement.
24 hours a day, 7 days a week.
And it dramatically lowers the overhead. The costs for administration, auditing, transfer agents, all that stuff eats into the returns for a small investor in a traditional fund. Tokenization cuts a lot of that out.
So that instant transferability is what creates this massive increase in liquidity. If an asset is held in one big chunk, you have to find one big buyer.
Right. But when it's tokenized, you just need to find a buyer for your single small slice, which you can do instantly on a global exchange.
It creates a constant market for things that were previously stuck, illiquid.
Think about rare art. Traditionally, that painting generates zero liquidity until you sell the whole thing, usually at an auction that takes months to set up.
But if you tokenize it,
you could have hundreds of thousands of people holding a fraction, creating an active secondary market for ownership stakes, even while the painting itself stays locked in a vault.
So the everyday impact really is the democratization of investing. But let's circle back to a complexity we mentioned earlier, governance.
Ah, yes. The governance question is probably the biggest non-technical hurdle here. If you break a $100 million asset into 100,000 pieces held by 50,000 people around the world,
who makes the decisions? Who decides when to sell or who to lease it to?
It can't be fully centralized, can it? Otherwise, you're just undermining the whole point of decentralized ownership. It's just old finance with a new digital wrapper.
So the smart contract has to provide a framework for that.
It does. And this usually means coding voting rights directly into the tokens. If you hold 0.1% of the tokens, you get 0.1% of the vote.
But how do you make that efficient? If 50,000 people have to vote on every little thing, like a new insurance policy, the asset would be paralyzed.
This is where the engineering gets really clever. You have to balance decentralization with operational efficiency. So you might set up different tiers of governance.
How so?
Routine decisions, like changing a maintenance provider, might be delegated to a small group of asset managers with a multi-signature wallet. But major decisions,
like selling the entire building,
would require a supermajority vote, say 67%, from all token holders. And it has to happen within a specific short voting window.
And the smart contract ensures that vote is fair, public, and tallied correctly.
And it ensures the decision is executed automatically once the vote passes. If the vote is to sell, the contract might be coded to automatically distribute the proceeds once it receives confirmation of the sale.
So fractional ownership gives us the market opportunity. The smart contract provides the trust and the governance to make it work at scale.
Without dissolving into chaos.
Okay, so we have the rules, and we have the asset sliced up into tradable pieces, but none of this value can move without a solid foundation. We need the infrastructure. We need the rails.
That is the perfect segue. If we stick with that transportation analogy, if smart contracts are the engines and fractional ownership is the cargo, Then the blockchain network is the infrastructure. It's the train tracks.
Let's really solidify that metaphor because I think it's the key to seeing how all three pieces fit together.
Okay, so the blockchain itself, the decentralized ledger, that's the train tracks. It's the secure global network that validates and secures every single transaction.
The tokens themselves, representing the shares, are the trains. They're the vehicles carrying the value across the network.
The smart contracts are the engines. They provide the power, the automation, and the rules for the train's journey.
And the fractional ownership, the economic value, is the cargo inside the train.
Exactly. And without strong, efficient, cost-effective tracks, the best engine with the most valuable cargo is completely useless. The infrastructure dictates everything.
And the crucial detail here is that there isn't just one set of tracks. We have different blockchains acting as different rails, each with different capabilities and, importantly, different trade-offs.
Yes, the classic blockchain trilemma: decentralization, security, and scalability. For RWAs, the choice of platform is a huge strategic decision.
Because institutions need maximum security and a regulatory compliance.
Absolutely. So let's start with the big one, the incumbent, Ethereum.
Why is Ethereum still the default choice for so many?
It really comes down to its proven security and its unparalleled decentralization. It has the most battle-tested code and the biggest developer community. For institutions handling hundreds of millions in assets, that robust security is paramount.
But the trade-off is speed and cost, the infamous gas fees and network congestion.
Exactly. Ethereum's main chain, its layer 1, struggles with scalability. We're talking maybe 15 to 30 transactions per second. That's just not enough to handle the volume of global finance.
That shortfall is what led to the rise of these other rails, right? Starting with things like layer 2s, like Polygon.
Right. And Polygon isn't trying to replace Ethereum. It's a scaling solution that works on top of it. It moves most of the heavy lifting, the transaction computation, off the congested main chain.
So if Ethereum is the major highway that's always jammed with traffic,
Polygon is like the high-speed commuter lane running right alongside it. It bundles up a bunch of fast, cheap transactions and then records them back to the hyper-secure Ethereum mainnet periodically.
so you get the speed and low cost, but you still inherit the security of Ethereum.
That's the idea. And then you have the newer, fundamentally different layer 1 platforms, things like Avalanche and Solana.
Which were built from the ground up for high performance.
Yes. Solana, for example, uses a unique consensus mechanism that lets it theoretically handle tens of thousands of transactions per second. That's very attractive for things like high-frequency trading of tokenized assets.
But what's the trade-off there? You don't get that kind of speed for free.
The trade-off is often in decentralization. Because of the high hardware requirements, Solana has fewer validator nodes than Ethereum, which makes it arguably more centralized.
So institutions have to weigh that. The absolute decentralized security of Ethereum versus the raw speed of a platform like Solana.
It's a constant debate. The rail you choose determines the asset's real-world usability based on three things: speed, cost, and scalability.
And speed is critical. In traditional finance, a 3-day settlement time means your capital is locked up for 3 days.
That latency introduces risk and cost. Instant T+0 settlement frees that capital immediately. If your blockchain is slow, you lose that massive value proposition.
And cost directly impacts the whole democratization promise. If gas fees are $50, your $100 fractional investment suddenly makes no sense.
And finally, scalability. The RWA market is predicted to be worth trillions. If your tracks can't handle millions of transactions a day without grinding to a halt, the whole system just freezes.
Which brings up an interesting point. Large institutions aren't always using these public chains, are they? They're also looking at private permissioned blockchains.
That's a crucial point of nuance. A permission chain is essentially a private set of tracks. Access is restricted, and transactions are only validated by pre-approved participants, like a group of banks.
Which they like, because it satisfies regulatory needs for data privacy and control.
Even if it sacrifices some of that public decentralization. So the choice of rail public, layer 2, high-speed L1, or private is completely tied to the asset being tokenized and the regulatory world it lives in.
The future of this whole space really does hinge on the strength and efficiency of these rails.
Completely. You need tracks that are fast, cheap, and strong enough to carry the value of the global economy.
And this deep dive into the mechanics brings us perfectly to the critical assessment. We've laid out how it's supposed to work, but what are the real-world hurdles that could stop this from happening?
We have to balance the excitement with some critical reality. This isn't a frictionless transition, it's a revolution, and revolutions always have challenges.
So let's start with the risks in the engine itself. Smart contract risk. We said they're just code, and code can have bugs.
And that risk is absolutely colossal. Since the smart contract is the final authority governing potentially billions of dollars, a single flaw or exploit can lead to immediate catastrophic loss.
We've seen it happen before, like with the DAO hack years ago. A coding exploit just drained the funds irreversibly.
And because execution is automatic and final, there's no undo button. The immutability that gives you security also means a mistake is permanent.
So what's the solution?
It demands an industry standard for quality that's far beyond normal software. We're talking about formal verification, using mathematical proofs to confirm the code behaves exactly as intended. And constant auditing by security firms has to be non-negotiable.
Okay, that leads to the second big challenge, the complexity of fractional governance.
Right. This is the operational nightmare of trying to get thousands of people to make a collective decision. In the old world, a few partners in an LLC could just get in a room and decide.
But with tens of thousands of token holders, each with a tiny stake, how do you manage anything? If a tenant in your tokenized building defaults, who votes on the legal strategy?
It's a huge challenge. First, just achieving a quorum is hard. And second, the cost and effort of involving everyone in every minor decision defeats the whole purpose of efficiency.
The asset just becomes ungovernable.
It can. But if the solution is to centralize decision-making back to a small management board, doesn't that undermine the whole decentralized ethos?
It creates this fundamental tension.
It does. The industry is experimenting with DAO structures for governance, but applying them to regulated physical assets is incredibly complex. You have to find that sweet spot between decentralization and operational efficiency.
And the third major hurdle isn't even about the tech, is it? It's about regulatory fragmentation.
This might be the biggest barrier of all for institutions. RWAs are physical. They exist in a specific jurisdiction. A token representing a building in Germany is governed by German law.
But the token itself is trading on a global blockchain,
creating a fragmented regulatory nightmare. How does one smart contract comply with US securities law, EU privacy law, and Asian market regulations all at once?
The legal wrapper helps, but the tech still has to interact with dozens of conflicting legal systems.
So what we need is regulatory clarity. We need standardization. We need legal recognition of the smart contract as the definitive record of ownership. Without that, institutions are going to move very slowly.
It really feels like the technology is way ahead of the legal framework that's needed to support it.
Absolutely. The tech allows for instant global transfer, but the law still requires paperwork and notaries that take weeks. We're building the technical rails, but we still need to build the legal bridges.
If we can solve these challenges, and a lot of smart people are working on them, the opportunities are just massive.
Genuinely transformative. Tokenization is positioned to unlock trillions in value. When you look at the size of global real estate or corporate debt, even moving a tiny fraction of that onto these efficient rails is monumental.
So the real work right now is diplomatic, in a way. It's about building these regulated bridges between the old world of traditional finance and the new world of blockchain.
It's an integration of CeFi and DeFi. You'll see traditional asset managers providing custody of the physical deeds, but using a permissioned blockchain to manage the digital tokens.
So tokenization isn't about destroying the old system, it's about retrofitting it with a much more efficient engine.
Exactly. It's allowing regulated institutions to finally leverage this technology without giving up the security and compliance they absolutely require. And once that liquidity is injected into an asset class, the change is irreversible.
No one who experiences T+0 settlement will want to go back to T+3.
Never. The global financial system runs on friction and delay. Tokenization promises to remove both, creating a faster, more robust, and ultimately fairer global market.
A powerful thought to end on, and it brings us to our final synthesis. This has been a true deep dive into the engineering of RWAs. Let's just synthesize the core mechanics one last time so our listener walks away with that complete blueprint.
It really comes down to the seamless interaction of three foundational mechanisms. First, you have the smart contracts. They are the automated, self-enforcing engine dictating all the rules of ownership and transfer.
Second, you have the fractional ownership model. This is the economic mechanism that slices up those high-value assets, democratizes access, and creates massive liquidity.
And third, the blockchain rails. The platforms like Ethereum, the Layer 2s, the high-speed networks, they provide the essential, secure infrastructure that determines the speed, cost, and scalability of the whole system.
And together, those three things bridge the gap. They achieve that ultimate goal, making the world's most valuable assets more accessible, transparent, and instantly tradable.
And knowing the how is what will be so important in the financial landscape you'll be navigating. Understanding smart contract risk or the trade-offs between different rails. That moves you from being a casual observer to an informed participant.
Which brings us to our final, provocative thought for you. Now that you get the mechanics, the engine, the cargo, the rails, and the challenges, it's time to connect this back to your own potential.
So ask yourself this question and really think about the potential here. What asset previously inaccessible to you would you want to own a fraction of today?
Is it a piece of a major corporate bond? Is it a stake in a huge renewable energy project that was only accessible to big funds before?
Or maybe it's a tiny piece of a masterwork of Renaissance art.
Think about the practical application of this knowledge. Tokenization is moving from concept to reality, and it is poised to change the very definition of wealth and ownership.
We encourage you to stay informed. Watch how these governance models evolve, and think critically about the security of the rails that will carry your future investments.
Because the future of ownership isn't just about accumulating assets. It's about having democratic, liquid access to fractions of the world's most valuable economic systems.
1,